G'day. Welcome to the Agricoach Podcast. For families on the land who want to grow their family's wealth and prosperity across the generations. I'm your host, Ben Law, and I'm the Financial Bloke. Welcome back to the Agricoach Wealth and Wisdom Podcast. My name's Ben Law, and I'm the Financial Bloke. Banks, love them or hate them, they're an essential part of running any agribusiness. Like rain, without money or banks, all farming operations would cease to exist. Banks are a valuable tool to be used on farm to secure your business and your family's financial future. But sometimes using an institution other than a bank can be the best option. And that brings me to non-bank alternatives. Back in the old days, I used to think that the only people who used non-bank alternatives were those in financial trouble. And originally, that was the case. But now, more and more producers are turning to non-bank lending options to solve specific challenges. Demand has increased, and that's why a number have entered the market over the past decade. A prime example of using a non-bank lender is when my dad was buying his new John Deere tractor a number of years ago. John Deere was struggling with sales and offered an outstanding interest rate, making it a far better deal than his own bank could provide. Another example is people using stock financing to buy livestock, with several options available on the market. To discuss the case for using non-bank lending to drive your agribusiness forward, we have Nick Davison from Legacy Livestock. Now, just to be clear and to keep the lawyers happy, today's episode is strictly for educational purposes only. It's not advice to use non-bank lenders, nor an endorsement or recommendation of any financial product or Legacy Livestock in any way. I have no affiliation with the company. Simply put, I met Nick at Beef 24 in Rocky this year, and he expressed an interest to come on the podcast. I wanted to learn more about the cases for how non-bank lending could be used as a tool to drive your business forward. And as Nick lives just down the road from me, and he spent 20 odd years in banking, I thought he'd be the best man to have a yarn with. So without further delay, welcome Nick.
G'day, how you going, Ben?
It's good to have you back again. Just letting everyone know that nothing ever goes perfect. So you and I recorded a podcast maybe 2 months ago. You said, Ben, did it all go well? I'm like, it went fantastically, Nick. I put it in the computer. Everything was right. Then my editor, Sam, big shout out to the podcast butler, looked at it and went, there's no Nick. The file's corrupt. And so we're back again. So thanks very much for being patient with me, Nick.
Pleasure, Ben. Maybe there were some things we didn't cover last time that might come up. It was a good conversation and I'm sure we'll get into it.
Absolutely. No, it was good, mate. So you and I obviously met up at Beef Week and we had a conversation up there and you said, look, Ben, if you ever want to come on the podcast and just talk about something technical around lending or finance or anything like that, because I've spent a lot of time in banking, let me know. And lo and behold, you live just down the road from me. So I've gone, perfect thing. Let's get here and have a discussion. So before we kick off, mate, can you just give us a quick summary of your background so we can get an idea of who you are and what your background is?
Yeah, thanks, Ben. So I grew up on the mixed farming enterprise down at Holbrook, southern New South Wales, and we ran sheep and cattle down there and always, had an affinity wanting to work in agriculture, whether it was, on the farm or outside of the farm. And as it eventuated, I went to university in Orange and did a degree there and spent some time in Sydney working in the meat business, which I really enjoyed, but ended up landing with National Australia Bank in their agribusiness team, working as a relationship manager and really got into that finance banking space, but always, again, with farmers and involved in agriculture. So, and more recently, it's in the finance space, but working with Legacy Livestock.
Excellent. And so how many years were you in banking?
I think it was 15 in the end. Yeah, and with banking, you do have the opportunity to move around. It's an attractive opportunities. It is what you make of it. So you can really, the geographies are far and wide where you can end up.
Well, you did better than me, Nick. I got out of university after finishing my ag economics degree and then spent 13 months in banking and was very quickly out of there into financial advice. Thank heavens. I found what I was good at after a period of time. So now, Nick, what I find, I work with a lot of high-performing families, and one of the traits that they have is to be curious. And one of the things I want to talk about today is talk about what we call non-bank lending or alternative finance. And the reason is not always are banks the right place to do your lending. There's other alternatives out there. Now, banks get bashed a lot over the years, and I had a really popular blog I did probably 7 or 8 years ago now saying banks are like a chainsaw. And what the metaphor was there is banks are like a chainsaw in the sense that they're a really powerful tool to do a job that you need them to do. And without banks, we couldn't run a business. We'd be storing our money under the mattress. We couldn't transact. There's a whole lot of things. And I think banks are really important. But if you don't know how to use them, like a chainsaw, they can cut your leg off. And so people have this real negative connotation with banks. But one of the things that I loved was talking to Richard Rains a couple of years ago on the podcast. And he had one of Australia's largest meat exporting companies. And he said, the best relationship I had, or the most important relationship I had, was with my bank manager, because the bank was the lifeblood of my beef exporting business. Now, as I said, we may not always use banks. There might be alternative options, and we want to be curious. So I've mentioned non-bank lending and alternative finance. Are they the same thing? And just to make sure from your point of view, we're all on the same page.
Yeah, I think when we talk about banks, you talk about APRA, which is the regulation authority that manages and oversees banks. And if you've got a financial license or a banking license in Australia, that's what classifies you as a bank. So we know, we've got the big four in Australia, Bendigo Bank, and then you've got building societies, and similar to that, they all hold a banking license. But then you have quite a large bucket where they're non-bank funders, so they're not under the same regulation. So that's sort of a broad definition, because that pool of non-bank funders can be quite large, but it's not non-APRA regulated space.
And I suppose some examples I can think of off the top of my head is like, if you go in, my dad bought a new John Deere a couple of years ago, and John Deere Finance was what he used. And you'll hear people go into Toyota and buy the new Land Cruiser, it's Toyota Finance. Is that generally what we're talking about, Nick?
Yeah, well, they're still a regulated space. It's not a free-for-all, so they'll be working under financial AFSL legislation. So they may not necessarily hold a banking license per se, but yeah, that's an example. So
now in the past, and many years ago, I would have thought anyone that used a non-bank lender was in financial trouble, i.e. they couldn't get money from a bank, so they had to go somewhere else. But again, many years ago, I worked out that I had pretty much the wrong end of the stick, and that sometimes alternative finance can be the place you want to go. And for example, was using that John Deere and Toyota Finance. Quite often you'll find the John Deere or Toyota or many other companies will do deals, and they'll say our interest rate is a lot cheaper than everyone else because, we're wanting to move more stock, more tractors, more John Deeres. Is that what you find, that it's no longer people that are in trouble that use non-bank lenders?
I wouldn't classify that as that, definitely, because there's such a broad array of offerings out there. You talk about dealership finance, they're huge multinational companies. So they've obviously seen an opportunity to try and attract more customers to buy their machinery. And they've got capital available that they can lend out to their customers at very affordable rates. Their main business is not making a return off that lending. Their business is moving more machinery. So they're using it in order to facilitate that. So in the livestock finance space where we operate, it's to facilitate, working capital needs that are there. It's a prompt turnaround time. So I guess where people get drawn to it is the due diligence is not as onerous as a bank might be. It can be quite a quick turnaround, and it's for a specific purpose. So I definitely wouldn't classify it as being in trouble. When I worked at the bank, I maybe had the same impression that they can't get their money off their bank and they're going to go elsewhere. But I definitely wouldn't classify it as that being the case.
So you've just mentioned a couple of the reasons there was it could be a cheaper interest rate. In some cases, like we mentioned, the equipment finance, it might be. Sometimes it might be more expensive. Also, you said a quick turnaround. Why else would people possibly use a non-bank lender?
Yeah, I think it's when you think about trying to manage your working capital in your overdraft and manage your account, you're trying to preserve that for running your business day to day rather than making capital acquisitions like machinery or livestock with your working capital. You want to effectively ring fence that lending purpose to a particular vehicle. So in vehicle, I mean to a particular loan type or loan provider, from ease of management, but also just not to erode your working capital. What I've seen happen over many years is people will max out their overdraft, and when you do a review on their overdraft, they've got, longer term liabilities or a build up of, longer term debt in their overdraft. They're not necessarily their day-to-day expenses. So the other thing is banks will often talk about their loan to value ratio, what's the property worth, and what's kind of leverage can we obtain from the property value. So they're really looking at that mortgage space. Clients who go to a non-bank funder, they want to preserve that equity and don't want to have an increased leverage on their mortgage. So they can use another vehicle to execute that, being, livestock finance, equipment finance, whatever it might be.
So what we're saying there is, I'll give an example and just correct I've got this wrong. So you've got your own property, you buy another property, and you've all of a sudden got to buy machinery or you've got to buy livestock to stock that property. And then all of a sudden, when you put the two properties together, you look at your LVRs, the banks start to go, oh, we can only lend you a certain amount. And then if you're buying cattle or machinery with that equity, then you're essentially using up all that loan to value ratio or that security that the bank's got.
Yeah, exactly right. And I wouldn't say, generally speaking, I know in the livestock finance space, you're not registering a mortgage on the property. You're not registering a charge on the title. You're not reliant on that property as a direct security for your loan. So, the bank will still look at what your assets and liabilities are on a holistic basis, but when they look at exclusively at the LVR position, that's what they'll consider, yeah. And we do talk to clients quite a bit on those walk-in, walk-out transactions that you see where there's livestock and machinery and these types of things. They've got a portion of value of those and make sure that they can access the capital to, execute the purchase.
Now, obviously, you're in the livestock finance game. And so I want to dig into this because I want to really understand it myself. And so if you can imagine these days, or what I see these days, Nick, is a lot of people buying an additional property and then they look at it and the numbers are so big these days that they go buy the additional property, then they've got to go buy the stock on top of that, tying it all into the LVR. So the ability to borrow money to buy livestock is the game you're in. So do you want to describe to me what livestock finance is in a little bit more detail to get us all to understand it?
Yeah, so I guess livestock finance in one form or another has been around for a long time. I guess companies that are specifically livestock finance providers maybe have not been in Australia for that long, maybe 10 years. But, livestock agents have often financed their clients on purchases and effectively carried them as a loan for a short amount of time. So that's effectively livestock finance. So it's really you're funding the acquisition of livestock for a set amount of time, to be repaid from the sale of those animals. That's as simple as you can make it. There's obviously so many different permutations within that, but that's in a nutshell what it is.
So talk me through it then, Nick. If let's say I'm running let's say it's a cattle property because we're using livestock finance, and I decide I either want to buy the neighbours or I want to go and adjust some cattle, and I've got a block that'll run, 1,000 head, and I want to go buy that 1,000 head. How does it technically work? They see a livestock finance company. How does that actually work out practically?
You go through a loan application process and they'll undertake a due diligence, get key financial information, and like any loan origination process, it's both objective information that you're gathering, but then it's also subjective, like all those really key elements like management and property type, and some of those are quite subjective in nature. So undertaking farm visits could be included in that. So, you successfully get an approval for a livestock finance limit, and then you can basically submit those invoices to the livestock financier, and they'll pay the invoices for the livestock. That can be done in a number of different ways. At Legacy Livestock, we draw down a loan. Basically, that loan sits on your balance sheet. The livestock, you own the livestock and you claim the GST, and we effectively pay if you're buying it through an agent, we'll pay the agent for the purchase of those livestock, inclusive of the GST. And that sits as a loan for a defined term, which is obviously pre-arranged with the client and what suits them.
Is there like a type of animal you have to buy? Like, do you have to buy breeders? Is there any sort of limitations to that?
Oh, look, generally speaking, they're more commercial in nature. There's not sort of higher value seed stock where I know we're not in that space where it's very high value breeding animals or bulls necessarily.
So it's more about turnover.
Yeah, in some ways, but we're also offering breeding livestock that are amortized over a set term. So the answer to the question is no, but it's more probably commercial livestock as opposed to higher value seed stock animals that we're financing.
And so when you say you finance, so you get a loan, draw down on the loan, you buy the cattle, there's an interest cost, there's a principal repayment. How does that all work, Nick?
I think you just you've got to look at go back to what the purpose of the funding is and understand where does the loan funding requirement start and when does it potentially finish? Because again, there's no sort of set standard rule. There might be people that are fattening lambs for 100 days on stubbles who want to turn over that loan really quickly. There might be other people who have bought P-tick animals. They're going to carve them down, fatten them, finish them both off, rejoin the cows. So it's hard to sort of say, oh, this is an exact example of what the structure might look like. I think the approach for us at Legacy has generally been, let's discuss the needs with the client and try and design an offering that suits them. So that might include paying the interest on a monthly basis. It might be principal and interest. It could be that you capitalise the interest right until the end of the loan term and then repay it from the sale of the animal. So there's lots of different structures available.
Does that depend on the need of the customer or the security risk sometimes?
Oh, look, it's primarily the need of the customer. It's obviously got to align. All financiers are going to have different risk thresholds that they're going to have to pass through as part of their due diligence. And I like to think of that within reason, you can put something in place that's going to be suitable to the client, but also meets that risk appetite of the financier.
Yeah, well, that makes sense if you can tailor it to what they need. And and I'm after some generalizations here, Nick. So again, I get that it's variable. If you took the typical person that used livestock finance, can you draw us a bit of a picture of that, or a couple of typical type examples of how they would use it and what it would look like, mate?
Yeah, for sure. So, clients in Central Victoria that were one of our inaugural clients when we started the business, they've a cropping operation, but they also wanted to improve they had additional carrying capacity. They wanted to try and maximise the return off their property. So they acquired, a mixture of breeding animals and fattening stock.
And trade cattle, yep.
And trade cattle and also sheep as well. And they were financed under varying terms. In that instance, when the animals were sold, the proceeds come to the financier. It repays the principal and the accrued interest, and the returns go to the client. So I guess what quantified that client is they weren't running the business at the optimal capacity for livestock. They saw an opportunity there. They didn't really want to use their bank finance because they were looking at other properties to acquire. That's when they approached us looking for funding that was, where we could get back to them quickly. Sometimes livestock trading could be quite opportunistic in nature, so people are making decisions quite quickly, want to be able to know that they've got the funding available to them quite promptly. So that's one example. Guys in central Queensland that were having a really good summer, had good rainfall, excess feed around them. They wanted finance for quite a 9 or 11 month trade to turn some steers over, and those seasons in where this client was located, to get that really good season doesn't come around that often. They've had extended periods of drought as well, so they really want to maximise when those opportunities arise and being able to be responsive to them in a short amount of time. The funding's for that specific purpose. There's a sort of known outcome at the end with the sale of the animal. You can execute it really effectively to benefit the client as well.
Because that is a big complaint I see from a lot of people, is that when trades come up, for people that are effective traders, quite often, especially when the seasons where they are fairly variable, that they need to act quickly. And a complaint they make quite often about banks is, especially if they're pushing their business really hard, which the entrepreneurial people generally are, there's not much lazy equity lying around. And so that quick turnaround, we know we've got the approvals, we can get those cattle on the ground. And then for some people, the ability to then say we'll capitalise the interest until we sell those cattle at the end means that they can not only execute the trade, but they can also take that cash flow squeeze out of the middle of it, knowing that comes with a risk as well. All these things come with a risk.
Yeah, that's right. And I mean, you don't have to look too far back in history to see what livestock markets can do. They can be very volatile and move quite quickly as well. And when we're doing our due diligence, we want to be sure that we can support those clients even when seasons and markets are against them, as well as when it's very good. So, I suppose the clients have got to be robust enough to withstand those kinds of shocks. But I think that's agriculture for everyone who's engaged in those businesses knows how much impact seasonal conditions can have.
And so that comes to my question, probably the myth that for non-bank lenders, if you're a bad lend, you're a bad lend, aren't you? I know that might be confrontational for some people, but just because you can't get money from a bank, that doesn't mean you can get money from a non-bank lender because they'll take anyone on. It's probably, I would guess from my point of view, that a non-bank lender, because we don't have the security over farms, then all of a sudden we have to do our due diligence more carefully, don't we?
Yeah, well, I think the organisations I've worked with, it's always been around knowing the customer, knowing their needs, understanding what the risks are, but also understanding what plans are in place, how robust is the business to mitigate some of those risks, not completely exclude them because there isn't such a thing as excluding some of those risks. It's probably just how they're best managing them. So, for every one client that we've been able to assist with livestock finance, we've said no to probably 8 or 10. And that's not necessarily because they're a bad lend, but they probably just didn't fit our particular risk profile that we've got for our business.
Yeah, and then you guys run a business, non-bank lenders run a business. They've got to make a profit, and they've got to manage that risk, which makes perfect sense. What would you say are there's the pros are, as we talked about, which was quick turnaround generally. As long as you're good with your information, usually is a quicker turnaround, can often be a quicker turnaround. It preserves your working capital, so you're not going to use up your overdraft limits, etc., trying to buy cattle and do a trade. And obviously you protect that LVR within your property security to be able to go buy another property, etc. That's the upsides. Is there any more upsides before we talk about the corresponding challenges, I suppose you'd say?
I think that fast responsiveness is a key one, but no, I think you've captured most of them there, Ben. Yeah.
So then on the other side, what are the challenges or what are the trade-offs to using a non-bank lender versus using your bank?
I guess that collateral position where the livestock financier is more reliant on the livestock as acting as the collateral for the loan. So I guess the risks are slightly elevated, which then in turn affects the costs of the client. So in most instances, your livestock finance is going to be more expensive than your term debt or your overdraft, which is secured by your mortgage. That's the predominant downside that we get pushback on from clients or feedback from clients on, it's more expensive to me. And I guess just in terms of a quick response to that is to encourage the clients to know what their cost to carry is for that particular trade. So let's understand per day or for the length of the trade, how much is that going to cost? So, at 12% for $1,000 steer, it's going to be, $120 for the year or whatever it might be. So understand what the interest cost is for the length of the trade. But, back to downsides as well is some banks won't like the fact that you're accessing finance elsewhere. They're not necessarily directly going to know, but you have to put it on your statement of position when you're doing your review with your bank. And, some might say, oh, look, you're impacting your overall equity position by increasing your leverage. But, again, you're increasing the asset value and improving your return at the same time. So, look, they're probably the main downturns is the interest cost and the potential impact that might be on your bank. But for the most part, that bank one has been, very minimal.
Yeah, and I think it's like all those things. If you do any lending through another bank or another institution, your bank is always going to be upset because they want 100% of all the lending and all control. And I have seen brokers over the years actually, to gain a little bit more control in negotiations, split their term lending between two banks. I'm not necessarily an advocate of that, but to take a little bit of control back. But also too, if you're a smart businessman or businesswoman, you should be looking at your trade and going, well, these are the costs, but what are the upsides here? And I'll give you a prime example. I have someone recently where they were in a review with their bank trying to get more funding, just come out of a drought, ready to go. There was trades to be made and they couldn't get the bank lending approved through to do it. And they said they literally missed out on about $500,000 worth of profit out of the trade because they just couldn't get the finance in place quick enough. And when you look at the financing cost, if there's a differential between the bank and a non-bank lender, in that case would have been absolutely negligible if they could have got the deal across the line. And I think that's where, if you use those sorts of facilities, you just have to be aware that, there's trade-offs, but there's trade-offs with your bank as well. If you put everything through your bank, then, you have the potential to be having a slower lumbering machine.
Yeah. And I think there's some really good trade calculators out there, and people may even just use an Excel spreadsheet of their own to understand, I've got my buy cost, I've got my freight cost, this is my running cost, animal health, commission for your agent, then this is my potential interest costs. Knowing those costs to carry, that's really, it's not necessarily what you buy the animal for, what you sell it for. It's understanding your margin, understanding your costs. So, I'm happily going to promote KLR Marketing. They're a marketing group that does a lot of work with livestock producers. The program that they put forward is fantastic in educating and building systems, putting systems in place to assist livestock producers knowing what their costs are and being able to put it into a format that they can understand.
No, well, that's sound business sense, isn't it?
Yeah.
Another one I saw, was it last year or the year before, Nick? They blur these years all of a sudden. But when the beef prices dropped and it got really dry in Queensland, I saw a family up there where they'd bought the neighbour's block a year or two before, so they'd taken a big step up in debt levels. They were in a very solid position, but still, and then it just completely dried up, like running out of water, no water facilities. Cattle started to lose condition. They had to start selling, and of course, we all know what happened to the beef prices. They just had heifers that they just couldn't sell. They were basically giving them away. And they went to the bank, and the bank was a slow lumbering machine, and they were running out of water, and they could have put those cattle in the feedlot and finished them off or pushed it out a little bit. They ran all the numbers. Again, I'm not advocating whether that was the right thing to do or not, but they ran all the numbers and they just couldn't get their bank to come across the line in time. And they ended up having to sell those heifers for probably 20% to 30% of what they were worth. And so for them, again, that would have been a prime example of how, if they could have taken advantage of that, mitigated the risk of dry and reduced cattle prices to be able to push through and trade them out.
Yeah, and as I said, you don't have to look too far back in the last few years. Livestock markets, towards the end of 2022 were at levels that people had never seen before, over $2,200 for an Angus weaner in the weaner sales. And I think most people would have acknowledged that potentially those prices weren't sustainable. But I guess on the back end of that is how quickly the market fell. It just showed the volatility that was there as well. So I guess in those instances, any clients or any people who are in that space have had to make a decision. You can only make decisions with the information that you've got at any particular given time, and also in terms of feed availability, seasonal considerations that they have to make. But I guess combined with that is, if they've got to put a plan in place, is communicating that really clear with their financier, whether it's a livestock financier or a bank or whatever it is. If there's a change in direction or a change in plan, is just being able to articulate that to your financier. I agree with Richard Rains from Sanger. Your financier, whether it's a bank or non-bank financier, they can be your best friend. The key thing they're probably going to ask for is that you're clearly communicating what the plan is, especially where there is these times of change, because if the financier doesn't know, well, they don't know. So if you're kept in the dark and there's loans expiring and you haven't heard from your client, that's when red flags go up. Whereas if they're proactively coming to you saying, this is the plan that I've got, I might need to carry these cattle for a bit longer, I've got this feed available, this is how long I can carry them for, I need to buy a bit more time to get to a more favourable outcome, then, that's when you're going to, as a financier, you're going to be more able to work with your clients, is if they're communicating and got those plans.
Yeah, there's two pieces of advice I try and share with the families I work with. And number one is, if you're going to be dealing with a financier, whether it be a bank, non-bank lender or wherever, you need to find the best bank manager or best manager you possibly can. And if you're going to use a broker, you want the best broker you can find, because you're never going to soar with the eagles if you keep rooting around the chook house. And you need to have someone really good you can work with that understands your business, understands the industry, and is totally on your team. They get it. And the second thing is you want to really communicate when things are going pear-shaped. So if you're sitting there looking out and going, geez, there's going to be a tightness in cash flow of 6 months from now, 3 months from now, or gee, my working capital's just not cutting it anymore, communicate that with the bank. It's not a failure. They want to know. Not communicating is a dirty, great big red flag for the banks. And look, I had this discussion the other day, and they'll be probably listening. So I'm not using any names, as I never, ever do. But one of the issues they'd run into with their bank was the fact they'd had the same working capital limit in place for the last 5 to 6 years. And of course, they've increased their turnover in the business because they've developed some more country. The costs of everything's gone up. And what they're finding is they keep hitting their limits on their overdrafts seasonally. And we hit this thing where they said, and they kept getting calls from the banks. And they're like, oh, we're failing, where the bank thinks we don't know how to run a business. And the true answer is that your loan limit hadn't kept up with the increase in your size of your business, and also the increase of inflation's effect on your dollars. And so instantly that was a paradigm shift for them to go, I need to go back to the bank and increase my limits. But they just felt so uncomfortable with communicating with the bank, because the natural reaction is when things aren't going right is to think I've failed, or I'm going to be embarrassed when I go to the bank. The reality is, if you're going through a shit time, I can guarantee pretty much everyone else in the district will be doing the same, and they'll be all going to their bank with cap in hand, explaining that. Best to be the first in line and get the best result.
Yeah. And I think even using the language like going cap in hand, it's quite not to criticise, but it's like quite a dated thought process, because, some of the most if you're progressive and know your numbers and know your business, and you really engage in these conversations with stakeholders within your business, like you've got your agent, your animal health, veterinarians, they're all your banker, accountant, all these guys are really important stakeholders in your business. So if you're proactively communicating with them, I don't, especially with your financier, I don't see it as like going cap in hand to them. Like, without you being proactive and making those plans and putting it in place, as you said, they're big red flags. So I think, banks want to hear from you. They actively want to be able to support you. But if you don't go to them and be able to clearly articulate it, sort of you're behind the 8 ball from the start.
And banks will support you far more than you think they will. That's the one thing I've been really shocked about over the years, is when people get to this point where they think, gee, I'm in strife, the bank's going to sell me up, the bank's not going to lend me any money. If you communicate well, if you show that you've got a good strategic plan in place, you've got the right people around you, you know what you're doing, you know your numbers, the banks will extend finance far greater than you ever would have thought they would have in a difficult time.
No, I've seen that firsthand. And I think if you look, not to go over old ground, but like with the Banking Royal Commission probably needed to occur. I was working in the finance sector at that time, and it was really hard to hear some of those stories, because for the most part, all my colleagues, all the people I was working with were working really hard to try and support their clients. And even the clients that were really struggling, you might have some where you're going to farm debt mediation with them. They've been on the farm for a long time. They're hard conversations to have, but I think that just a continual communication, really critical. Yeah.
And it's a positive thing to have the communication. I found over the last, say, 10 years, when you sit down with bank managers and give them an update of what the strategic plan is, because one of the things I have is like a board of advice, advisor alignment, where you sit the professional advisors in a room, accountant, bank manager, financial advisor, etc., and you talk about the strategic plan, the fact that in 2 years' time you're going to buy another property, you're going to increase your working capital, you're going to hit a tight time in the next 2 years as you grow your breeders and your numbers. That's like rocket fuel to your situation, because once that bank manager gets what you're trying to achieve and has full confidence in your strategic plan or your family, then all of a sudden you've got an advocate. You've got someone that'll go into the credit team, the team that's making the decisions, and will go into bat for you. And most of the time, if you've got a really smart, good value driven bank manager talking with a credit team, you're going to get a much, much better outcome.
Yeah. No, I'd agree with that for sure.
So, mate, as we start to wind up, this has been good, Nick. Are there any more myths that you'd like to bust about non-bank lending before we start to wind up?
No, I think it's just don't discount it as being an option. Know that there's options out there. Be prepared to investigate those options. You might be surprised as well. There's a lot of value in investigating those things. Even if you don't follow through with it, you can have the conversation. Is it going to be suitable to you? So I think don't discount it at all. Really just sort of knowing your numbers and knowing what the ultimate goal is. What's the purpose of the funding? What's the plan and the direction? And then being able to articulate that is really critical. So not in terms of myth busting. I think it's just ask the questions. If you don't know, there's no such thing as a silly question. So, reach out and ask those questions.
Perfect. Well, Nick, if anyone wants to get in contact with you, how can they do that, mate?
They can go to our website, legacylivestock.com.au. There's a lot of information on there, as well as our contact details, so they can go to our website. That's probably the best place to start, Ben.
And I think what you said to me when we tried recording before was the fact that you said you like to have a chin wag as well and talk through people's situations. So if anyone's actually thinking, hey, could this work for me? I've got this situation, then you're more than willing to talk to people about their scenario to see if it works.
Oh, definitely. I just call them whiteboard scenarios. Let's get the imaginary whiteboard out. If you're having the conversation, let's work through a few of these different scenarios. Ben's going to have my direct contact details in the notes for this episode, so they can contact me directly. My mobile and email address will be on there. So there may not be business that comes out of that conversation necessarily, but I just enjoy having those conversations and trying to, maybe blow up some of those myths and also work through some. I've had numerous calls in the last few weeks because of some failed crops where people have contacted us saying, I'm going to turn it into hay, or I'm going to go and buy some stock to run on it. Let's work through the scenarios. How much is the finance going to cost me? What's my cost to carry that particular animal? And so far, nothing has eventuated from those conversations, but they've been engaging, and I've helped inform that client on what direction they might take.
Perfect. Excellent. Now, Nick, before we head off, one of the things that we talked about when we connected up at Beef Week was I get the privilege of dealing with some, as I call, high-performing families in the ag sector, and that's part of what I love about what I do. And I'm always fascinated about what sets those high-performing families apart from, the others, the ones that don't perform as well. And you've managed to do the same, mate, in your banking career. You've been exposed to, the people that are really doing some great things. And I'm not talking about the people necessarily that are just financially the most successful. I'm talking about strong family relationships. They're able to maintain a business. They're able to grow, etc. So from your point of view, mate, I'd like to know what's one of the most valuable lessons you've learned from someone that you've worked with over the last 20 years that's really stuck with you?
Gee, that's an interesting one. It's probably topical for a lot of people. It's around family succession and multiple generations working on the farm. And a great example I saw of where it was working was that they understood their strengths and understood their roles within the business. So their roles were clearly defined and they could execute those roles. They obviously had the support of the other family member, but people weren't treading on each other's feet. Say if it was a mixed farming operation with a cropping and a livestock enterprise, they had someone looking after the livestock, someone looking after the cropping. There was clearly defined roles. It was like a hierarchy or a structure of known key roles and what tasks that they fulfill. So I guess having some shape and structure around the business, trying to look at it from a professional standpoint, because big farming businesses and family businesses, they're enormous enterprises. So I think not having a structure in place can be a recipe for disaster. Whereas if there's, good structure, good roles and designated roles for different people within the family group, and they treat it like a business structure, then that's what I've seen work in that space.
Yeah, I couldn't agree more. Accountability roles, understanding what's expected of you. And then there's one thing that I came up with a number of years ago was there's the 3 C's once you get into those roles or you start looking at those roles. The first one is character. You have to have a good character in those roles. You have to be competent. So competence means I either can do that job really bloody well and it's in my unique zone, or I'm going to learn how to be the most competent in that role, and it's okay to learn. And the last one is commitment. You must get it, you must want it, and you must be totally committed to that role. And I think if you get those accountability roles and they've got the 3 C's, then that's rocket fuel for the family situation.
Yeah, I think some of the strongest enterprises in Australia are farming families. I genuinely believe that. And I also think that they're fantastic environmental advocates as well. I see so many people that are working really hard to leave a legacy behind, pardon the pun, but leave a legacy behind in terms of looking after their asset, the environment and their property. So, and often that's not as well communicated to the broader public as how strong farmers are at doing that. But I think I see that as well, as they're stewards of the property, stewards of the environment. They're not looking to rip the guts out of it and extract every single last dollar. They're actually looking to leave something better than they found it. And I always really, really admire businesses and farming families when I see that. It's really energising when you do see that as well.
Yeah, without a doubt. Totally agree, mate. Excellent. Well, look, that's it for today. Nick, is there anything finally you want to throw in before we sign off?
No, fantastic, Ben. I've enjoyed the chat the second time round. It's been good. I think we've covered off a few different, the conversation was different, but no, really enjoyed it.
Awesome. Well, I really appreciate your time coming on today, and look forward to catching up soon.
Thanks a lot. Cheers, Ben.
Hope you enjoyed that today. I think the number one characteristic of a high-performing family or a high-performing individual is to be curious. So I wanted you to be more curious today and learn about something you may not have come across before. Just to be really clear, and I want to nail this down, is today was for education purposes only. I'm not an accountant. I'm not a lawyer. I'm not a financial advisor. I'm not a mortgage broker or banker. Today was just for educational purposes. I don't have any affiliation with Legacy Livestock or any other association other than I just wanted to learn more about livestock finance and how that can actually be used. If you are going to use such a product, make sure you do your research, get advice from an appropriately qualified individual to make sure you get it right. If you enjoyed the episode, make sure you share it with your family and friends. And if you could go onto Apple Podcasts or Spotify and give us a 5-star rating, that'd be fantastic. It's the best way to say thanks if you're enjoying the episodes. My name's Ben Law. I'm the Financial Bloke, and I'll catch you with the next episode.